So let's start by asking, what is a fair value gap? During an impulsive move, when candle 1, 2, and 3 close. In a bullish example, if the high of candle 1 and the low of candle 3 have a space between them on the body of candle 2, the space between them is what we call a fair value gap. Now the theory goes, once a fair value gap is created, price will bounce off of it. Now the question is, how do you know price will bounce off of the fair value gap? And when it bounces, why does it bounce off? And where exactly will it bounce off in the fair value gap? Let's go on YouTube and see if the gurus can give us an answer.
The fair value gap. One of the biggest trends going on in the trading space right now. And there's a reason for that, because of how well they work in the market. But not all fair value gaps are created equal. For instance, this fair value gap ended up not working. And this fair value gap did end up working. So why did this fair value gap work and this one didn't? Well, so here on this chart, we have multiple bullish fair value gaps. The lowest fair value gaps will always be the strongest and have the highest priority, while the highest fair value gaps will be the weakest and have the lowest priority. So in a perfect scenario, you should try to trade the lowest fair value gap possible. Same thing with bearish fair value gaps. If you have multiple bearish fair value gaps are 0, 0.5, and 1. This will give you something that looks like this. If you have multiple fair value gaps on a chart, just grab this tool and mark from the low of the move to the high of the move. This will give you an easy way to see what fair value gaps to trade. In a perfect scenario, you should not be trading any fair value gaps that are in the upper portion of this tool. You only want to be trading gaps that are in the lower portion of this tool. Same thing with shorts, mark the high of the move to the low of the move. You only want to be trading fair value gaps that are in the upper portion of the tool. If you follow this step,
actually 3 different levels of fair value gaps that you can look for to take better trades. The first is IOFED, which stands for Institutional Order Flow Entry Drill. This is when price barely reaches into a fair value gap before expanding away from it. It's best used when there's heavy momentum in the market with large, energetic candlesticks. Next, we have CE, short for Consequent Encroachment, which is the midpoint of an inefficiency or gap. When price returns to a gap, it doesn't always fill the entire imbalance. It can just barely enter the area and then reverse, or it can continue to trade to the midpoint before changing course. Lastly, we have the FVG fill. This is when price retraces and completes the fair value gap. Now, when this happens, one of 2 things will result. It can respect the level and create a large wick, rejecting and moving away from it. Or it can completely disregard the gap. Because there are so many possibilities with fair value gaps, we use these 3 levels to help us monitor price action. Now, I understand, this is a lot to digest in a video.
Let's take a look at this fair value gap here. Now that we've drawn the fair value gap, let's mark it down and go to a lower time frame to really see the magic behind. Now this is the secret behind price bouncing off fair value gap. I bring to you the King order block. This is what price will be mitigating when you see price magically bouncing off fair value gaps. Now let's mark it and go deeper on a lower time frame to see what is inside the King order block. And this is what we find. This is a rally base rally. And whenever there is a rally base rally, we get this pattern. And this is a demand zone. And if you look closely, you will see it's also an order block. So at the end of the day, a fair value gap is just basically a lower time frame order block or supply and demand. Let's forward test and see how price hits these precise zones inside a fair value gap, not some random place. Instead of guessing where price is going to bounce and using the whole fair value gap as an entry, notice how more precise this is. Which means a tighter stop and a better risk-reward ratio. So now you know the secret of fair value gap. They are basically just order blocks, breaker blocks, and supply and demand zones in lower time frames. If you trade fair value gaps and you want a simpler way to look for supply and demand inside, you can use the Key Level Wedge Pro, which draws lower time frame supply and demand levels on your current chart. And all you have to do is to only trade fair value gaps with supply and demand zones inside them. Like this. One more thing. It's our anniversary month. And we decided to launch the MT5 version of the Key Level Wedge Pro on promotion. Subscribe to the channel to know what time it launches in the next few days and take advantage of the discount. Happy trading.